is also the key statement on financialisation. So choose your references carefully. There's lots of now work out published about financialisation. It's a term that 10 years ago when I raised it, everyone said, oh, it's a load of bollocks. But now it's actually used in popular discourse. Oh, it's financialisation. Financialisation is just an organising concept. It's a mobile concept. So be careful in how you use it. So there are kind of the references. Let's get into the lecture. Well, the start point of this is actually the previous decade. Around about kind of the second half of the 1990s, everybody started to talk about shareholder value. And here, the Lex column on the back of the FT. If you don't regularly read the FT, you don't really have to, but I always recommend having a look at the Lex columns. That's the back page of the main newspaper. Always has an interesting, should we say, almost cheeky and critical look at what management has said and what the outcomes have been. But in kind of Lex column, the discussion was, here is another management destroying shareholder value. And it was about management who were destroying or producing shareholder value. This discourse hooks, and it hooks kind of tightly, up to a point where all management now come under pressure to generate shareholder value. Now, shareholder value becomes for management an all-purpose justification. If you're kind of closing a plant, oh, it's down to shareholder value. Oh, if you're acquiring another company, oh, it's all about shareholder value. It becomes a kind of a DIY reason to do anything. And that gives you, if you're asked to present a case, to kind of look at the fault lines between the rhetoric and the reality. The rhetoric is shareholder value is used for all kinds of things. The reality is, over the decade that we were going to look over, well, actually it's going to be 30 years that we're going to look over, management overall hasn't performed. But any kind of metric requires the evangelizers. It's just not enough to repeat it in newspapers. It's not enough for kind of management to say, oh yes, we're pursuing shareholder value. You've got to have the consultants that arrive on the doorstep with their own metrics. You know, my kind of feeling generally on consultants are that they tell you the time on your own watch. And I think it was no different in that decade. There were lots of metrics. In your reading, you'll find huge amounts of metrics. Shareholder value, market value, value added, economic value added. You can line them all up, but they're all kind of variants about measuring whether the performance of the company is improving from a financial perspective. Do they earn their keep in terms of the capital that they've invested? You'll find Stern Stewart will turn up a lot, EVA. But the key kind of point is, what was actually going on? What is going on? And what was going on? And that's kind of much more kind of interesting, because as soon as you start getting behind the labels, what you start to find is that hardly any company generates a 12 to 15% return on capital employed, yet they're going to try to. So where is shareholder value? Well, it's migrating to different places, but the centre in the 90s and the early 2000s was and is the US and the UK. It was always limited in places like Germany and Japan, partly because of the institutional structure, but partly because it wasn't mainly accountants in charge of companies. There were kind of different disciplines running companies. So it's limited elsewhere, but it's changing. And if you looked at the Finnish stock market, I think about 70% of the Finnish stock market is actually owned by overseas shareholders. In France, traditionally thought of as kind of being very insular. Well, it's not 35% anymore. I think it's 45% of all shares are actually owned by overseas shareholders. But still, the majority of stock markets are still organised on a national basis. That is, American institutions invest the largest proportion in the American stock market. And in Britain, it's the case, although I think probably this year, maybe next year, that's going to be beneath 50%. But I think the first time ever. But in terms of kind of institutions, it's about kind of US institutions, and these are mainly pension funds and insurance companies, looking for returns that cannot be met from their domestic stock market. What tends to happen here is, rather than this kind of being a kind of a call for the creatives to come to the fore, everybody keeps copying each other, and they do the same thing. A herd mentality exists, where if one pension fund goes offshore, another one does too. So in terms of where, it's the UK and the US, but be aware it's happening elsewhere. Much more muted, but it will be. And in terms of kind of Japanese investors, they're beginning to increasingly invest in overseas stock markets. In terms of what is it? Well, the shift is the measure of success. How are you going to measure success? Traditionally, you look at kind of measures of success in productive economies, where management is interested in taking market share. It might be about how much market share you've got, or how much productivity is improved. But you look at kind of annual report and accounts now, particularly in the US and Britain, very little is actually written on market share, market success. It's all about the financial returns. I'm not saying that isn't important, but it's become so skewed that I think people are beginning to forget that you can only make money out of selling a service or a product. But in the UK and the US, market success, productive success, well, interesting as it is, it's not enough. It's not enough because the UK and the US investors, these are big institutions, and I would count myself as being a culprit in this. My pension fund, the USS, which is a collectivised pension scheme, also becomes increasingly aggressive, demanding increasing returns from the agents that are, companies like JP Morgan, who are given these funds to generate the returns. They, in turn, translate that pressure onto companies. So there's huge pressure to do financial results. I mean, you may argue, well, shouldn't a capitalist corporation be generating profits? Yes, you're absolutely right. But you're also looking at what price and at what cost. And are you squeezing R&D to generate current returns at the expense of long-term returns? And in terms of kind of context, we're really looking at, comes back to the stakeholder question, in whose interest should capitalism be run? It's about the US and the UK forms of capitalism. 80% of all shares in Britain, and I think it's about 65%, 60 to 65% in the United States, of the whole economy, corporatized economy, is listed. Just to bring that kind of, again, into context, not all the economy is corporatized. In the British economy, less than half of the British economy is actually companies. So a lot of it is going to be households, self-employed, people working for government, non-profit organisation. But half the economy is corporatized. And if it is corporatized, of that half, it's listed. So what we've got is nearly 80% of the population investing in these companies, and only 25% of the economy actually organised for profit. Now, that has profound implications about, can that small bit generate the returns required by the rest of us? But in terms of kind of quoted firms, those of you kind of, who want to do some kind of historical kind of look at it, if you looked at annual report and accounts back to, say, 1985, 86, you will find no information about share price, how the share price has performed, no discussion about meetings with shareholders, and many of them, those companies, wouldn't even have investor relations departments. Now, every company has an investor relations department. Quoted firms just cannot ignore what the shareholders want, these institutional shareholders. These institutional shareholders who on average 30 years ago held shares for 8 years and currently hold them for less than 8 months. And if you want to be critical in your essays, why don't you ask, well, who is the shareholder? Because the shareholder doesn't stick around for very long anymore. But you can't ignore the capital market because, I mentioned it in earlier lectures, less than 1/3 of the companies that were in the FTSE 100 and the S&P 500 are still there today. After 30 years, less than 1/3 are left in there. Because that same stock market also licenses mergers and acquisitions. And firms need to raise finance, they also need protection if they're going to be acquired. So that gives a kind of the powerful volatile cocktail that allows shareholders to assert themselves, despite many of them being pretty transient and not holding shares for very long. So what is kind of financialization?